This is Roman ShareShare, your number one online resource for buying property with your update, your real estate update. Today's a special update. I'm going to go over so much interesting information. The thing is, I didn't realize just how misinformed everybody was until I started reading the news and what people are writing and the surveys that are coming out. And today we're going to go through a ton of information about what people think is going on in the real estate market versus what's really happening out there. It's completely different, complete dichotomy in views on what's going on in the real estate market. I'm going to be talking about real estate market across the country, as well as our local Los Angeles localized real estate market, which is completely different. All right. So first and foremost, if you like this video, make sure you please hit the like button down below so I know to keep creating this content. You find this information valuable, and I will continue making videos just like this. A couple of our current projects, we've got a couple of projects that are on the market in Florida. We have 3 different properties, all really good cash flow projects. So if you're looking for an investment for cash flow, place to place your money, we've got some really good projects in Florida. We're looking for condos here in California. I have a couple of buyers that are looking for condos. Very difficult to find. Why? One of the things I'm going to be talking about, there's no new listings coming to the market. No new listings. Even though the days on market are going up, I'll go over all of this in a minute. I'm getting ahead of myself. All right. To anyone watching on Instagram, be sure to head over to Facebook after this to check out the links and slides to the content I'm going to be going over today. There's a lot of valuable information you'll want to see everywhere where I'm getting this. All right, let's jump right in. Number 1, Americans are widely misinformed about the reality of the housing market. What's going to happen here is completely different from what people are talking about. And the funny thing is, I was at a bachelor party a couple months ago, and the guys there were asking me, so Roman, what do you think is going to happen to the market? And I said, you know what? I don't think things are going to change significantly. Always the number one thing to do is look for the right house. When you find the right house, get it, whether it's now or whether it's a year or 2 years from now. And they brushed me off. They said, you're just a realtor. That's what they all say. Well, I'm going to back it up with some facts today, and I'll show you exactly why I'm absolutely correct. This year, according to a survey by released just this Tuesday, 28 million Americans plan on purchasing a home this year. This year. Okay. We're not talking about, oh, there's no one out there. No one can afford it. 28 million are planning on buying a home this year. The reality of it, just a small percentage are going to be able to do it. 2 things. Number 1, lending's tighter. And number 2 is only 6 million existing homes sold in 2021. So you got 5 buyers for every 1 property that hit the market back 2 years ago. And this year it's going to be even tighter than that. So there may be 6 properties, 6 buyers, 7 buyers per property. So how are prices supposed to crash if you got multiple offers still coming in for the properties? All right, next. You have a lot of buyers out there that are still looking at these interest rates and what's happening in the economy. 92% of them, of the millennial home buyers, which make up the majority of today's buyers, say that inflation is impacting them. It's hurting them. It's hurting their buying power. They're going out less to eat. They're getting less groceries for the same amount. Everything's more expensive. But it's still not impacting their purchasing plans. They're still going to go out and buy. So even let's say out of those 28 million surveyed, 92% of them are still going to go. We're still looking at 5 to 7 offers per property. How are we going to crash? Okay. Well, let's look at, I've seen it. I've seen it out there. Misconception. I've seen out the prices are dropping like a fly. Okay, let's take a look at that. Starter home prices are actually increasing rapidly. Luxury is absolutely in a slump. The luxury market, defined as the top 10% of properties being sold, is definitely declining. Just this week, I was part of a broker owner manager discussion, only to a limited few of the brokers in California, where their top economist their chief economist, the deputy chief economist, Oscar Way, who's been with them for a long time, came out and spoke about what they're seeing in terms of real numbers in the economy and what's happening to the housing market. Okay, let me show you what he says about where the prices are and what's dropping rapidly. And it's not even what he says. This is raw data. Okay, year over year price growth. If you'll notice here, last year, so year over year, we're talking about last January versus this January. This is 0 to 20% in price. So if you look at a 0 to 100, at 100 is the most expensive house, at 0 is the cheapest house in the market. Okay, so the lower, very low segments of the market, year over year in January, especially January is a slow month, so is December. This is actually December data. So December is a little bit of a slow month. So you see that the prices went down slightly in this lower segment of the market. Okay, this is also California specific. In the 80th to 90th percentile, which are the homes right now roughly at about $1 million to $1.5 million here in LA County, they went up in price. People are still trying to buy these homes. They're trying to get into those homes. And the very top, the top 5%, they dropped. They dropped nearly 10% in value. Why? A lot less buyers. The ones that are buying those may be more affected by the economy. But the bottom line is the lower segments of the market, prices are actually increasing. You'll see here that they've actually gone down a little bit, but that's because last year the prices of these properties, these low price properties, went bananas. Okay, there were 35 to 50 offers for some of the properties we were looking at with our buyers. Unheard of, unprecedented. All right. Well, how do we know what's going on in our segment of the market? Okay, well, let's take a look at some of the cities here locally so you can see what exactly is happening to pricing. Okay, so this makes up most of the San Fernando Valley. Okay, where a lot of my buyers are. For the sake of time, I'm just going to show the valley, but this is indicative of what's happening in Los Angeles City as well. And you can see here prices for many of these properties, okay, have declined slowly, but it's mostly because the top of the market is gone down significantly. So you're seeing a lot. Let's say, for example, a city like Tarzana. Tarzana has homes. Majority of those homes are between 800,000 to approximately 1.8. But there are a few outliers in the past year on the $6 million, $7 million, $8 million range that really raised that bar. And so those prices have come down because those are not selling, those $7-8 million homes. But we have a lot of the 800 to $1 million homes, $1.2 million homes that are selling. So this deceivingly shows that there's a little bit of a price drop, but this is also very low inventory. So we're talking about the entry level homes are the ones that are selling. The top of the market homes are not selling, and that's weighing down prices. So when people are seeing these prices, they say, whoa, the market's tanking. That's not the case at all. Let's actually look at what is happening to prices. Now, I'm going to go right into this one here. Okay, one second. Here is what's really happening in LA County. Okay, so what we're showing for this is December 22. Okay, we had a decline, significant decline in quantity of transactions. Nearly half of the sales are down. Okay, we have our median SFR, median single family residence, prices decreased 3.6% from last year. Okay, keep in mind it went up and then it came down. So we're only about 3% reduced from what we were last year. Now you look at this active listings number and say, whoa, we really a lot more properties have come to market. I'll show you why this is a very deceiving number. Okay. All right. But in terms of days on market, our days on market went from 12 to 26. But look at this statistic, sales to list price. So what properties are listing at, you cannot be a greedy pig in this market. If your house is worth $1 million, you cannot list at 1.2. You used to back in June, you did, and you got 1.3. You cannot do this today. Today, you have to list at market or even a little bit below market to make it even more appealing. But if you do, prices homes are selling for 99.3% of what they list. I have some buyers that are coming to me. Oh, everything's crashing. On that $1 million home, I want to make an offer of 700,000. Okay, we can go ahead and do that, but you won't even get a response, and probably they won't even talk to me after that, because look at where prices are selling. This means that for that $1 million home, that home sold for $993,000, $7,000 discount. Okay, a lot of properties are reducing their prices because 36.7, one third, more than one third of the properties on the market are reducing their prices. But why? The agents I'm speaking to are telling me because their sellers are still looking at June, May pricing, which was crazy pricing. Appraisers aren't even using those as comps anymore. You have to understand that those aren't even valid comps. They were so completely bonkers, these complete outliers of prices. And if you look at those peaks and say, hey, that's the peak, then we're down significantly. Sure. But people in the industry, appraisers, mortgage people, real estate agents are not looking at that as the peak. That's not what the real comps that we're using. We're using comps from the last 90 days, 120 days, and then we will look at comps if we don't have enough from a year ago, a year and a half ago, because those were the real market and where the real market was. All right, let's continue. I'm going as fast because I got a lot of stuff to go over. All right. Another misconception is prices. On average, people think that they're going to spend, this is nationwide number, $270,000, $269,200. But that figure falls more than $100,000 short of where median home prices are. Median home prices throughout the country are $388,100 in December. Okay. The $269,000 number we haven't seen since 2013. In California, if you look at Los Angeles County here, our prices year to year actually went up 6%. Okay, that includes everything. That includes condos, single families. The number I showed you before was just single families. Okay, but our median number here in California is 849,000. So if someone comes to me on $1 million house and says, I want to make an offer for 700,000, that's not even our median. You're way off in your expectations, and we're not seeing those types of deductions here in California. Other markets are experiencing pain. Austin, Texas, San Jose, Boise, Idaho is in deep trouble. Phoenix is experiencing a lot of pain. They have significant price declines. Here in Los Angeles, here in Southern California, we are not seeing these price declines. All right, let's move on. All right, well, what about all the low quantity of sales? That's because no one's buying, right? No, that is not because of that. The reason there are such a low quantity of sales is because there's no supply. There's literally nothing on the market. And the ones that are on the market, the days on market that you're seeing, have been on the market forever. So people have looked at those properties and decided, hey, this seller is unrealistic. Their price is way out of whack with the reality of where we are today. Or the property has problems. And here's where the opportunity lies in buying property today. The opportunity lies in buying the property where you can, with having cash, so you can go in and do the updates. Today, the down payment requirements and how much people are having to put down and how much people are having to come in with, and their payments are higher today because of the interest rates have gone up. The opportunity is getting properties where you can add a little value and add some work. Getting that cosmetic fixer, because most of the people that are buying today, they're having to put so much more of their money towards the down payment to get that loan, even that they don't have the money to fix it up. And that's what's disqualifying them from purchasing a lot of these properties that have problems. Okay. So, but supply is a major issue still. Let's look back at the value again. You see that number. Oh, we have so many more listings. Let's look at what that really looks like. In December in Tarzana, there were a total of 9 properties that came to market. Studio City, you're looking for 3 properties came to market. This is year over year. Woodland Hills, there's been a lot of properties in Woodland Hills, right? A whopping total of 15 properties came to market, and there's hundreds of buyers vying for those properties. So no, you're not going to see that $1 million property go for 700,000. You're not. You're seeing still 4 or 5 different offers on these properties. You're seeing, as opposed to, of course, 40 that were back in May, June. Okay. Well, what about all those new listings that we're seeing, the inventory that increased significantly. There's very little inventory that's coming to market. And the reason we're seeing the days on market is because of the inventory that's there already. Take a look at new listings. New listings are down 15%, 15.4% in December compared to last year. And last year was a record down number. If you take a look at this here, we're at the lowest new listings. This goes back only to 2018, but I think the lowest new listing since 2007 even. There's no properties coming to market. Why is that? All right. Well, there's something that this economist called the lock-in effect. This people don't understand, and this is a key to what's going on in the market today. 85% of the people in California that own homes right now, have an interest rate lower than 4%. 99% of them, yeah, that's right, 99% of all homeowners in California have an interest rate under 5%. So if you're a homeowner, seller, and you're thinking, hey, I need to move up, I need to get more square footage, I'm having a new baby, whatever the case is, these are people, or we're starting a housing unit, we're in a condo, we want to get ahead of a baby, we want to get a house. The problem is that they're not going to exit their 3% mortgage to go into this 6.5% environment in a higher price point environment. What they're doing, a lot of them, is if they can, they're taking out their cash or using the cash that they would use as their down payment and doing projects in their house, expanding their home. But this is why we have no new listings. This is why we have the shortage. This is why we have a decrease in sales. This is the key to everything that I'm going over today. But what about all these foreclosures that I'm hearing about? They're on the horizon. We're going to get flooded with foreclosures. All right, let's talk about that. Yes, in the last housing downturn, there was a ton of foreclosures. Ton. There were a lot that were modified and people were kept in. But take a look at the statistics. Take a look at where we really are, and you tell me if you think there's going to be a lot of foreclosures. Back in 2006, we had 20% of the borrowers, the people buying homes, putting 0% down. 20%. This last year, 3% did. Percentage of homeowners, home buyers with a second mortgage were 45%. Took out a second mortgage on top of it at a higher rate. Last year, there were 2.2%. 21, there was 1.9%. There was 2% of the people took out a 2% loan. Back in 2006, 1/3 of the buyers took out an adjustable rate mortgage that adjusted upwards and created a crazy payment spike that created a unaffordable environment for them. They couldn't afford that new payment. Less than 7% of the borrowers and the buyers that bought in 2022, when the prices already were super high, took out an adjustable rate mortgage. And that's also the environment where the rates were already high. But before that, in 2020, 3% took out an adjustable rate. 2% took out an adjustable rate from 2021. So let me ask you a question. You have a ton of equity in the home. Half of the buyers, 49% of the buyers, put down 20% or more. So you have a ton of equity in the home. You have an interest rate that's below 3%. Your payment's not going to go up. So unless you really lose your job and don't have any cash, don't have any money, and need to sell, and I still don't see that because you still have a ton of equity. You could still get out and cover all of those expenses. Where are these foreclosures going to come from? They're not. Okay, Roman, well, what about all these buyers that are slashing their price? Okay, let's talk about that. I went past one slide. Let's go here. They're slashing prices. Okay. Here is why people are slashing prices. Most of the agents I've spoken to have sellers that are still looking at June, July as the pricing that they want to base their list price at. Unfortunately, we're in a different market. That was an inflated list price that has no reality in this market. The price per square foot is that I'm seeing on some of these properties that we're looking for our buyers are just astronomical. When we talk to these agents, they say, you're absolutely right. I can't convince my seller. Okay, I understand. But how many buyers are now willing to pay above asking price? We dropped from 73% of buyers that are willing to make an offer above list price and buy a house above list price down to 20%. So people are not buying above list price and above real market value. They're seeing the comps. They're also, buyers are looking at the last 3 months of comps. Sellers are still looking at 6 months ago in comps. A little bit of a disconnect there, a lot of a disconnect. But the reality of it is that the buyers today are pickier. They got more options because they're not settling for the things that were overlooked when there was 30 offers on a property. They were just trying to get in before the interest rates went up. Well, today's buyers are pickier. Their rates are higher. Their payments are higher. So they want to make sure they get a good property, and they don't want to overpay for it, unlike before. So that's why you're seeing a lot of price drops on properties, because the sellers are still being unrealistic with what the reality is. Okay. But Roman, these rates are the highest we've ever seen. 61% of Americans told surveyors that the current mortgage rates are unprecedented, meaning that they've never been around before. 61% of the people think that these are the highest interest rates ever. The reality is, over the last 50 years, 50 years, the 30-year mortgage rates have averaged 7.75%. 7.75%. And we had 7% interest rates as far back as 2008. So not even that long ago. Let's see where we are today in terms of interest rates. Interest rates have gone up and they've dropped. The last time I did an update was on the 6th, so 3 weeks ago. The 30-year fix was 6.2%. It's back to 6.2. It was down 6.18 this morning, still at 6.2. The 15-year fixed was actually 5.7% 3 weeks ago. Now it's down to 5.26. The jumbo's 5.6 was 5.6. Today it's 5.7. The 5/1 arm was 6.21. Now it's 6.25. So interest rates have pretty much stabilized, and they were higher just 4 or 5 months ago. They've come down. So interest rates have stabilized here, but they are expecting that within a couple of days, the Fed will hike the Fed's fund rate another 1/4 to 0.5%. Most think that it's going to be 1/4. And in a month and a half, they think it's going to be the last rate hike of another 1/4%. So if that's the case, then Fed funds rate are going to go up by another, let's say, 0.5%. But there's no direct correlation between mortgage rates and Fed funds rates. Of course, the mortgage rates may rise a little bit, but what we've seen is a steadying of it. And many expect that next year, that by the end of this year, we'll see reduced prices. So let's talk about what really is happening in the market. Home sales are going to stay weak. Okay. We're going to have a reduced number of home sales. And the reason why is because there's a lock-in effect. People are not coming to market with the sale of their homes. They're waiting it out until we don't know how long, because they have a 3% rate. Where are they going to go? Interest rates are likely not going to come down to 3% unless there's a major crisis in the global economy. So, but they might stabilize at between 4, 5 in the 5s, somewhere around there. Okay. Prices are going to soften a little bit this year, but the supply shortage will keep them from going down significantly. So yeah, people are waiting. Oh, I'm going to wait. We're going to have a crash. Okay. They're estimating that rates are going to, that pricing is going to come down by this year by about 3%. Okay. So you're going to wait for your $1 million home to come down to $970,000. I understand. What is around right now are actual deals. We have only 3%, 3 offers on every home, whereas before, a year ago, we had 50. So if you get a good realtor who knows how to negotiate these things, who knows how to get out in front, but not to the very front, knows how to work the terms to get the best deal, but not at the highest price like we do. We're doing this right now. We just entered escrow 2 weeks ago on a condo that we were not the highest offer on, but we felt it out. We know exactly where we were, and that takes experience. All right. Inflation is improving, but it's still going to remain an issue this year. But they are expecting that inflation will completely get tamed by 2023, based on where it's already gone. It was at 9.1%. The most recent figures are at 6.5%. Rates could rise further because of these next couple of hikes, but they're estimating that they will come down by the end of the years. And by the end of the year. And most importantly is that, a lot of people during this last run up back in July, June, they went straight to the listing agent and said, hey, you represent me. That way I'll get the deal. Today, you actually have a chance to get the deal. And if you get the right realtor who's representing you, then you actually have a chance to get discounts and credits correctly. Whereas you go directly to the listing agent has a fiduciary duty to the seller. So they're not trying to get you the lowest price. Whereas our number one job is to get you the lowest price, make sure you know everything about the property, okay, and get you credits on top of that. Fully investigate the property and get as much money for our buyers as possible during the escrow. All right. We went very long today, and I apologize. I think there's still a number of people that are still with me. I thank you all for bearing with me for so long. Wow, there's a lot more than I even thought. And these typically we get to about 150 to 200 views on these within a week. So I hope that this information was key. I want to make sure that you understand exactly what's going on in the industry. I want to make sure that you guys exactly know where the market is, because there's a lot of I'm hearing crazy things. Everything's going to crash. There's going to be 1 million foreclosures. Prices are going to be half of what they used to be. We're going to be able to pick up land for pennies on the dollar. We're not seeing this. The real people that are in the business, that understand the economy behind this, are not seeing. We're going to see a little bit of a price decline. But if you're looking to get that property, you're not going to get a steal. Not in this market. Something can happen in the future. But this year, next year, there's no signs of any crash or any imminent free fall, not in Southern California. All right. The quote of the day real quick is, marry the house, date the interest rate. If you find the right house, get the house. Even at these high interest rates, get it there's programs right now. You can do buy downs. You can get the lower rate. But the point is that interest rates will come down. Everyone's forecasting that. So marry the house, get that house that you want. If you find that perfect house, that's the key. That's what's hardest to find, because there's no new listings. So all the stuff that you're seeing on the market that has huge days on market, people have already picked these over and they're not interested. There's issues with these homes. If you find the right house, marry that house, date the interest rate. You'll date a new interest rate quick enough. All right. Remember, check out the links to the content on my Facebook page. If you like this video, please make sure you hit the like button so we know to keep creating this content. I went way over today, but there's so much valuable information. Go listen to it again. Have a great weekend, everybody. This is Roman Shersher, your #1 online resource for buying property.